Welcome. Today we're diving into the fascinating world of the stock market. Whether you're just curious or ready to invest, understanding the basics is the first step. The stock market can seem overwhelming at first, but with the right guidance, anyone can learn how it works. In this video, we'll break down the essentials from what stocks are to how you can start investing. Let's begin our journey by exploring what the stock market actually is and why it matters to so many people around the world. Stock represents a share in the ownership of a company. When you buy a stock, you become a part owner of that business, no matter how small your share. Stocks are also known as equities, and they give you a claim on part of the company's assets and earnings. This is why stock prices can rise and fall based on how well the company is doing. Understanding this basic concept is crucial before you start investing. Next, let's see how stocks are bought and sold in the market. Stocks are traded on exchanges, which are marketplaces where buyers and sellers meet. The most well-known exchanges include the New York Stock Exchange and Nasdaq. These platforms make it easy for investors to buy and sell shares quickly and efficiently. Prices are determined by supply and demand, which means they can change rapidly throughout the day. Now, let's look at the main reasons why people invest in stocks. People invest in stocks for many reasons. The most common is to grow their wealth over time. Stocks have historically offered higher returns than other investments like savings accounts or bonds. Some investors also buy stocks to earn dividends, which are payments companies make to shareholders. Of course, investing in stocks comes with risk, but with knowledge and patience, it can be a rewarding way to build your financial future. Next, let's talk about the different types of stocks you can buy. There are two main types of stocks: common stocks and preferred stocks. Common stocks give you voting rights in the company and the potential for dividends. Preferred stocks usually don't offer voting rights, but they pay fixed dividends and have priority over common stocks if the company goes bankrupt. Understanding the difference helps you choose the right investment for your goals. Up next, let's see how you can actually buy your first stock. To buy stocks, you'll need a brokerage account. This is an online account that lets you place orders to buy or sell shares. Many brokers offer easy-to-use platforms with helpful tools for beginners. When choosing a broker, look for low fees, good customer support, and educational resources. Once your account is set up, you're ready to start investing. Next, let's walk through the process of buying your first stock. Buying your first stock is easier than you might think. After funding your brokerage account, search for the company you want to invest in. Enter the number of shares you want to buy and choose the type of order: market or limit. A market order buys at the current price, while a limit order lets you set the price you're willing to pay. Review your order, confirm, and you're done. Now let's talk about how to track your investments. Once you own stocks, it's important to keep an eye on your portfolio. Most brokerage platforms offer tools to track your investment's performance. You can see how much your stocks have gained or lost, check news about the companies, and make changes as needed. Remember, investing is a long-term journey, so don't worry about daily ups and downs. Next, let's discuss the risks involved in stock investing. All investments carry some risk, and stocks are no exception. Prices can go up or down quickly, and there's always a chance you could lose money. However, risk can be managed by diversifying your investments and doing your research. The key is to invest only what you can afford to lose and to stay informed. Let's move on to the concept of diversification and why it's so important. Diversification means spreading your investments across different stocks, industries, or even asset classes. This helps reduce the impact if one investment performs poorly. For example, if you own stocks in technology, healthcare, and consumer goods, a downturn in one sector won't hurt your entire portfolio. Diversification is a key strategy for managing risk and building long-term wealth. Next, let's look at the role of research in making smart investment choices. Before buying any stock, it's important to do your homework. Research the company's financial health, business model, and future prospects. Read news articles, check earnings reports, and look at analyst opinions. The more you know, the better your investment decisions will be. Good research can help you avoid costly mistakes and spot great opportunities. Now, let's explore the difference between short-term and long-term investing. Investors often choose between short-term and long-term strategies. Short-term investing means buying and selling stocks quickly to make fast profits, but it's riskier and requires more attention. Long-term investing involves holding stocks for years, letting your money grow with the company. Most experts recommend a long-term approach for beginners, as it's less stressful and more likely to succeed. Next, let's talk about dividends and how they work. Dividends are payments that companies make to their shareholders, usually from profits. Not all stocks pay dividends, but those that do can provide a steady income stream. Dividend-paying stocks are popular with investors who want regular cash flow in addition to potential price gains. When choosing stocks, consider whether you want growth, income, or a mix of both. Let's move on to the concept of market indexes. Market index is a group of stocks that represents a portion of the overall market. Popular indexes include the S&P 500, Dow Jones, and Nasdaq. These indexes help investors track the performance of the market or specific sectors. Many investment funds are designed to mimic these indexes, making it easy to invest in a broad range of companies. Next, let's discuss mutual funds and exchange-traded funds, ETFs. Mutual funds and ETFs are investment vehicles that pool money from many investors to buy a diversified portfolio of stocks. Mutual funds are managed by professionals and traded at the end of the day, while ETFs trade like stocks throughout the day. Both offer an easy way to diversify and reduce risk, especially for beginners. Now let's look at how to set your investment goals. Before you start investing, it's important to set clear goals. Are you saving for retirement, a house, or your child's education? Your goals will determine your investment strategy and risk tolerance. Write down your objectives and review them regularly. This helps you stay focused and make better decisions even when the market gets volatile. Next, let's talk about the importance of patience in investing. Investing is a marathon, not a sprint. The most successful investors are those who stay patient and let their money grow over time. Markets will have ups and downs, but staying the course usually pays off. Avoid the temptation to react to every market movement. Instead, focus on your long-term goals and trust your strategy. Now, let's explore the basics of reading stock charts. Stock charts show how a stock's price has changed over time. They can look complicated, but the basics are easy to grasp. Look for trends such as whether the price is generally rising or falling. Pay attention to volume, which shows how many shares are being traded. Learning to read charts helps you spot opportunities and make better decisions. Next, let's discuss the role of news and events in the stock market. News and events can have a big impact on stock prices. Company earnings, new products, or changes in leadership can all move the market. Broader events like elections, economic reports, or global crises also play a role. Staying informed helps you understand why prices move and how to react. Next, let's look at the importance of keeping emotions in check when investing. Emotions can be your worst enemy in the stock market. Fear and greed often lead to poor decisions like selling in a panic or buying at the top. The best investors stay calm and stick to their plan even when the market gets rough. Practice discipline and remember your long-term goals. Next, let's talk about the costs involved in investing. Investing isn't free, there are fees to consider. Brokers may charge commissions for buying or selling stocks, and funds often have management fees. These costs can add up over time and eat into your returns. Always check the fee structure before investing and look for low-cost options. Next, let's discuss the importance of taxes in investing. Profits from selling stocks are usually subject to taxes known as capital gains tax. Dividends may also be taxed. Tax rules vary by country, so it's important to understand how they apply to your situation. Some accounts, like retirement accounts, offer tax advantages. Consider taxes when planning your investments to maximize your returns. Next, let's explore the concept of compounding. Compounding is when your investment earnings generate their own earnings. Over time, this can lead to exponential growth. The earlier you start investing, the more you can benefit from compounding. Even small, regular investments can add up to a significant amount thanks to this powerful effect. Next, let's talk about the importance of regular investing. One of the best habits you can develop is investing regularly, no matter what the market is doing. This approach, called dollar-cost averaging, means you buy more shares when prices are low and fewer when they're high. Over time, this can lower your average cost and reduce the impact of market volatility. Next, let's look at how to avoid common mistakes. Many beginners make the same mistakes, like chasing hot stocks, ignoring fees, or selling in a panic. The best way to avoid these pitfalls is to stick to your plan, do your research, and stay patient. Remember, investing is a long-term journey, not a get-rich-quick scheme. Next, let's discuss the importance of reviewing your portfolio regularly. It's important to check your portfolio regularly to make sure it matches your goals and risk tolerance. Rebalancing means adjusting your investments if one area grows too large. This keeps your portfolio on track and helps manage risk. Set a schedule to review your investments, such as once a year. Next, let's talk about the role of professional advice. If you're unsure about investing, consider talking to a financial advisor. Advisors can help you set goals, choose investments, and create a plan that fits your needs. Look for someone who is qualified and puts your interests first. Professional advice can be especially helpful for beginners or those with complex financial situations. Next, let's explore the concept of risk tolerance. Risk tolerance is your ability to handle ups and downs in the market. Some people are comfortable with big swings while others prefer stability. Knowing your risk tolerance helps you choose the right investments and avoid panic during market drops. Take a risk assessment quiz or talk to an advisor to find your comfort level. Next, let's discuss the importance of staying informed. Stock market is always changing, so it's important to stay up to date. Read financial news, follow market trends, and keep learning about investing. The more informed you are, the better your decisions will be. Make learning a lifelong habit to stay ahead. Next, let's look at the benefits of joining investment communities. Being part of an investment community can be very helpful. You can share ideas, learn from others, and get support during tough times. Online forums, social media groups, and local clubs are great places to connect with other investors. Just remember to do your own research and not follow the crowd blindly. Next, let's talk about the importance of setting realistic expectations. It's important to have realistic expectations about investing. The stock market can be unpredictable and there will be ups and downs. Don't expect to get rich overnight. Focus on steady long-term growth and be prepared for setbacks along the way. Patience and discipline are key to success. Next, let's explore the role of technology in investing today. Technology has made investing easier than ever. Online platforms, mobile apps, and robo-advisors allow you to manage your portfolio from anywhere. Many tools offer research, analysis, and automatic investing features. Embracing technology can help you stay organized and make smarter decisions. Next, let's discuss the importance of security in online investing. Keeping your investments safe online is crucial. Use strong passwords, enable two-factor authentication, and only use trusted platforms. Be cautious of scams and phishing attempts. Protecting your account helps keep your money and personal information secure. Next, let's look at the importance of reviewing your investment plan regularly. Your investment plan should change as your life changes. Major events like a new job, marriage, or having children can affect your goals and risk tolerance. Review your plan regularly and make adjustments as needed. This keeps you on track and helps you reach your financial goals. Next, let's talk about the benefits of starting early. The earlier you start investing, the more time your money has to grow. Thanks to compounding, even small investments can become significant over decades. Don't wait for the perfect moment, start with what you have and build from there. Next, let's discuss the importance of keeping records of your investments. Good record keeping is essential for successful investing. Track your purchases, sales, dividends, and fees. This helps you stay organized, prepare for taxes, and measure your progress. Many brokers offer tools to help you keep records automatically. Next, let's look at the importance of financial education. Investing is a skill you can improve with education. Read books, take courses, and watch videos to expand your knowledge. The more you learn, the more confident and successful you'll become as an investor. Make learning a lifelong habit. Next, let's talk about the importance of having an emergency fund. For investing, make sure you have an emergency fund. This is money set aside for unexpected expenses like medical bills or car repairs. Having a safety net lets you invest with confidence, knowing you can handle surprises. Aim for 3 to 6 months worth of living expenses. Next, let's discuss the importance of insurance. Insurance protects you and your family from financial setbacks. Health, life, and property insurance are all important parts of a solid financial plan. With the right coverage, you can invest without worrying about unexpected events. Next, let's talk about the importance of setting up automatic investments. Setting up automatic investments is a smart way to build wealth over time. Many brokers let you schedule regular contributions so you don't have to remember each month. This helps you stay disciplined and take advantage of dollar-cost averaging. Next, let's discuss the importance of reviewing your beneficiaries. Make sure your investment accounts have the correct beneficiaries listed. This ensures your assets go to the right people if something happens to you. Review your beneficiaries regularly, especially after major life events like marriage or having children. Next, let's talk about the importance of staying flexible with your investment strategy. The market and your life will change over time, so it's important to stay flexible. Be willing to adjust your strategy as needed, but avoid making impulsive decisions. Flexibility helps you adapt to new opportunities and challenges. Next, let's discuss the importance of celebrating your progress. Take time to celebrate your investment milestones, whether it's your first stock purchase or reaching a savings goal. Recognizing your achievements keeps you motivated and reminds you of the progress you've made. Investing is a journey, and every step forward is worth celebrating. Next, let's summarize what we've learned. We've covered a lot in this guide to the stock market. From understanding what stocks are to setting goals, managing risk, and building good habits, you now have a solid foundation. Remember, successful investing takes time, patience, and continuous learning. Stay focused on your goals, keep improving your knowledge, and enjoy the journey. Let's wrap up with some final thoughts. Thank you for joining this guide to the stock market. With the basics in hand, you're ready to start your investing journey. Remember, everyone starts somewhere, and the most important step is to begin. Keep learning, stay patient, and let your investments grow over time. Wishing you success and confidence as you build your financial future.